y el negativo. En los próximos minutos analizamos el contexto de los mercados. Lo hacemos con Jay Pelosky, founder and principal of TPW Advisory. Jay, thank you so much for having us a few minutes.
Thank you. Nice to be speaking with you again.
Jay, considering the current market scenario, can we understand that the market is underestimating the risk of a recession in the US?
Well, it's amazing how quickly we've moved from worrying about inflation to worrying about recession. And it's resulted in very violent moves across assets, whether it's the Treasury market, where the volatility index hit its highest point in 2 years last week, or if it's in the commodity space, where many commodities have fallen off 20 or 30%. That's generating some concern about recession. Actually, equities have been the quietest and most stable of the major asset classes, with the VIX index, which is the equity volatility index, actually under 30 for much of the past week, which is a sign of relatively calm markets. And so we actually had last week was only the second week in the last 3 months that had a up result for the S&P. So I think in terms of the question of recession, we'll know a lot more in the next couple of weeks when we have earnings results and we hear from the companies themselves about what they're seeing in terms of demand. We do not expect a recession in the U.S. here at TPW Advisory.
And Jay, we will remember forever Draghi's whatever it takes. And now Christine Lagarde says we will go as far as necessary. Is the ECB trying to tell markets that it has no limits on its actions?
Yes, I think that's right. I mean, the ECB understands that it's navigating a tricky environment between ending QE and preventing kind of fragmentation or, very wide spreads between the peripheral countries, particularly Italy, and the Western European countries, France, Germany, et cetera. So I think the point to me is that the ECB is well aware of the risk. They have the tools necessary. They will use the tools necessary. And I think that's what the market has determined as well. The spread between Italy and Germany have come in pretty dramatically and not anywhere near as wide as the spread has been in prior periods of real market uncertainty. So personally, I do not see the fragmentation risk, as it's called. I don't see that as a particularly key issue for European financial assets.
And Lagarde said that the ECB will hike the 3 key interest rates. We are talking about marginal lending facility, deposit facility, and rates for main refinancing operations. Why is the ECB doing this? What effect could it have on the economy?
I think clearly they're worried about inflation, as are pretty much every central bank around the world at this point, outside the PBOC in China and the BOJ, I guess. So in Asia, the inflation concern is not anywhere near as great as it is in the U.S. and in Europe. And in the case of the ECB, the issue, I think, is really whether or not they will end up hiking as much as they say they're going to, given that the big push, inflationary push in Europe is energy-driven. And we've seen energy prices come off, even during the time when Russia is reducing gas shipments and the G7 is talking about capping oil prices, exports from Russia. We've seen Brent crude be very stable. We've seen European gas prices go up, but they're nowhere near the levels they reached 3 or 4 months ago when the Russian invasion first occurred. So the potential, therefore, for inflation to come down quickly in Europe is quite high. So central banks are demonstrating kind of their toughness to the markets, that they're going to take inflation seriously and deal with the issue. And I think that's probably a good position for them to be in. But as we go forward, I expect inflation to come down. As we talked about earlier, commodity prices are down, gasoline prices, food prices are down, labor market softening here in the U.S., housing softening here in the U.S. So I would expect over the next couple of months and quarters, the inflation story to be much less worrisome, and that probably allows the Fed and perhaps the ECB to take a little bit more time and assess whatever rate hikes they've put in place to that point, assess the utility of those and how they want to move forward at that point.
Jay Pelosky, as always, thank you so much for your analysis.
Great being with you again. Thank you.